The real estate market in Ontario is facing a perfect storm, and some cities are about to experience dramatic price corrections that could reshape the entire housing landscape. Today, we're counting down the top 9 cities where home prices are expected to crash in 2025. And trust me, you won't want to miss what's happening at numbers 5 and 2. They might completely change how you think about Ontario's housing market. Number 9, Thunder Bay. Thunder Bay might seem like an unlikely candidate for a housing crash, but that's exactly what makes it so dangerous for current homeowners. This northwestern Ontario city has been quietly building a bubble that's about to burst in spectacular fashion. Here's something that will shock you. Thunder Bay's average home price has increased by over 45% since 2020, despite the city losing population every single year. Think about that for a moment. Fewer people, higher prices. That's not sustainable economics, that's speculation gone wild. The city's economy relies heavily on resource extraction and transportation. But here's the kicker. Major mining operations are scaling back, and the port activity that once drove prosperity is declining rapidly. When your economic foundation crumbles, housing prices follow like dominoes. But here's what really matters to you as a potential buyer or current homeowner. Thunder Bay's rental market is already showing cracks. Vacancy rates are climbing toward 8%, which is nearly double the provincial average. When landlords can't fill units, property values start their inevitable descent. The emotional reality is harsh. Families who bought homes in Thunder Bay thinking they were making a smart investment are about to watch their equity evaporate. Young professionals are already leaving for Toronto and Ottawa, creating a demographic time bomb that will accelerate price declines. But Thunder Bay is just the beginning of our countdown, and what's coming next will show you how geography and economics collide in unexpected ways. Number 8, Sudbury. Sudbury presents a fascinating case study of how a one-industry town faces housing market devastation when that industry shifts. This mining capital of Canada is experiencing something that should terrify anyone holding property there. Here's your attention-grabbing fact. Sudbury has more houses for sale per capita than any other major Ontario city, and properties are sitting on the market 60% longer than they did just 2 years ago. That's not a correction, that's a market in freefall. The mining industry that built Sudbury is undergoing massive automation. Vail and Glencore have announced significant workforce reductions through 2025, with thousands of high-paying jobs disappearing. When mining families earning 6-figure incomes suddenly face unemployment, they can't sustain mortgage payments on homes that were priced for boom times. But here's the deeper issue that affects you whether you live in Sudbury or not. This city represents the canary in the coal mine for resource-dependent communities across Ontario. The same forces hitting Sudbury are building pressure in dozens of similar communities. The human cost is already visible. Local real estate agents report that 30% of their listings are from families forced to relocate for work. These aren't strategic moves. These are desperation sales that drive down comparable prices for everyone else. Young families who bought starter homes in Sudbury are discovering they're trapped. They can't sell without taking massive losses, but they can't stay because the jobs are disappearing. It's a financial prison that will define this market crash. And if you think Sudbury's challenges are unique, wait until you see what's brewing in our next city. Number 7, Sault Ste. Marie. Sault Ste. Marie might be small, but it's about to deliver a masterclass in how demographic shifts can obliterate housing values. This border city is facing a perfect storm that will make 2025 unforgettable for all the wrong reasons. Here's a fact that will make you reconsider everything. Sault Ste. Marie has the oldest average population in Ontario, with over 25% of residents above age 65. But here's the twist that creates the crash. These seniors are starting to sell their homes en masse to move to assisted living or relocate closer to family in larger cities. The city's steel industry, once the backbone of the local economy, continues to shed jobs through technological advancement. Algoma Steel's recent restructuring eliminated another 200 positions, and more cuts are planned. When the primary employer reduces its workforce, the ripple effects devastate the entire housing market. But here's what makes this particularly brutal. Sault Ste. Marie sits right on the U.S. border, and currency fluctuations are making American properties increasingly attractive to local buyers with flexibility. They're not just selling their Canadian homes, they're taking their purchasing power across the border entirely. The emotional reality for current homeowners is devastating. Many bought their homes decades ago when the steel industry was thriving and the community was growing. Now they're watching their life's biggest investment become worthless, as buyers simply don't exist for the volume of homes hitting the market. Local schools are reporting declining enrollment, which creates a feedback loop. Young families won't move to a community where schools are closing, and without young families, housing demand evaporates completely. The infrastructure is aging too, with massive municipal expenses looming for water and sewer upgrades that will require tax increases right when property values are falling. It's a municipal nightmare that will accelerate the housing crash. But Sault Ste. Marie's challenges pale in comparison to what we're seeing in our next city, where international factors are creating unprecedented market pressure. Number 6. Windsor. Windsor is experiencing something unique in Ontario's housing market, a crash driven by international economic forces that most people don't even realize are happening. This border city's proximity to Detroit was once an advantage, but it's becoming the source of its housing market destruction. Here's your jaw-dropping fact. Windsor's housing market is directly tied to the U.S. auto industry, and electric vehicle transition is eliminating thousands of traditional automotive jobs on both sides of the border. Ford's Windsor engine plant announcements for 2025 will shock you when they're finally made public. But here's what's really driving the crash. Wealthy investors from Toronto bought up Windsor properties during the pandemic, thinking they were getting a bargain. Now they're all trying to sell simultaneously, as they realize the rental income doesn't cover their costs, and property values aren't appreciating as expected. The currency exchange situation creates additional pressure. When the Canadian dollar weakens, Windsor residents with means start looking across the river to Detroit, where they can get significantly more house for their money. This brain drain of higher-income residents leaves fewer qualified buyers for Windsor properties. Here's the emotional impact that should concern every homeowner. Windsor families are discovering that their proximity to the U.S. border, once seen as an asset, now makes them vulnerable to economic forces completely outside their control. American economic policy decisions directly impact their home values in ways they never anticipated. The rental market tells the story clearly. University students are choosing to commute from Detroit rather than rent in Windsor because the exchange rate makes it financially advantageous. When your rental market is competing internationally and losing, property values have nowhere to go but down. Local businesses are struggling with the same border dynamics, creating a community-wide economic stress that will accelerate housing market declines throughout 2025. But Windsor's international challenges are nothing compared to what's happening in our next city. And this is where things get really interesting. Number 5. Barrie. Now we're getting to the cities that will truly shock you. And Barrie represents something that should terrify anyone who thinks proximity to Toronto guarantees housing market stability. This is the city I told you not to miss, and you're about to understand why. Here's the fact that will change everything you think you know about Ontario real estate. Barrie's housing market was built on a lie. The pandemic created an artificial demand surge from Toronto buyers who thought they could work remotely forever, and now that remote work policies are reversing, this entire market is collapsing. Barrie's average home price increased by an astronomical 78% between 2020 and 2022, making it one of the most overvalued markets in all of Canada. But here's the devastating reality. Those Toronto buyers who drove up prices are now being forced back to the office, and they're panic selling their Barrie properties to move closer to work. The commuter train service that was supposed to make Barrie a viable Toronto suburb has been plagued with delays and service interruptions. GO Transit's reliability issues mean that the fundamental premise of living in Barrie while working in Toronto is broken. When transportation infrastructure fails, housing markets built on commuting collapse immediately. But here's what makes this crash particularly brutal. Barrie attracted young families who stretched their finances to buy homes they thought would appreciate quickly. These aren't investors who can absorb losses. These are regular families who put their life savings into properties that are now worth 30% less than they paid. The psychological impact is creating a feedback loop of panic selling. When neighbors see for sale signs on every block, they start questioning their own property values and rush to sell before prices drop further. This mentality creates the very crash they're trying to avoid. Local businesses that expanded during the boom years are now facing a customer base that's either selling and leaving or cutting spending due to negative equity in their homes. The economic multiplier effect of housing wealth destruction is devastating entire neighborhoods. Here's the part that should worry everyone in Ontario. Barrie represents the vulnerability of any community that became overvalued due to pandemic-era market distortions. If it can happen in Barrie, it can happen anywhere. And speaking of anywhere, our next city proves that even established manufacturing centers aren't immune to housing market devastation. Number 4. Kitchener presents one of the most complex housing market crashes in Ontario because it's happening despite apparent economic strength. This technology hub was supposed to be recession-proof, but 2025 is proving that assumption catastrophically wrong. Here's the fact that will reshape your understanding of tech-driven economies. Kitchener's tech sector was built on cheap money and venture capital that's now completely dried up. Companies like BlackBerry that once anchored the local economy are shadow of their former selves, and dozens of startups that employed thousands are simply disappearing. The University of Waterloo's co-op program, which fed talent into local tech companies, is seeing graduate placement rates drop to decade lows. When the pipeline of high-earning young professionals dries up, rental demand collapses, and property investors face massive losses. But here's what makes Kitchener's crash particularly insidious. The city invested heavily in downtown revitalization projects based on projected population growth that isn't materializing. Municipal debt is rising while property tax revenue falls, creating a fiscal crisis that will force tax increases right when homeowners can least afford them. The emotional toll on families is severe. Many moved to Kitchener thinking they were getting Toronto amenities at smaller city prices, but they're discovering they have neither. The downtown core that was supposed to rival Toronto's vibrancy is filled with empty storefronts and abandoned development projects. Here's the data that should alarm every property owner. Kitchener's housing inventory has increased by 45% year over year, while sales volume has dropped by 32%. That's not a balanced market correction, that's a collapse in buyer confidence that will accelerate throughout 2025. The rental market is particularly brutal. Purpose-built rental developments that broke ground during the boom are coming online just as demand evaporates. Landlords are offering multiple months of free rent just to attract tenants, which destroys the investment calculations that supported high property prices. But Kitchener's tech-driven collapse is mild compared to what's brewing in our next city, where government policy changes are creating a housing market apocalypse. Number 3, London. London represents the most heartbreaking housing market crash on our list because it's devastating a community that did everything right. This university city followed all the economic development playbooks, yet it's facing a housing market collapse that will define the next decade. Here's the shock factor. London's housing market was artificially inflated by international student enrollment that increased by over 200% since 2018, but immigration policy changes for 2025 will cut that student population by at least 60%. When your housing demand is built on international students who suddenly can't come to Canada, the crash is immediate and brutal. Western University and Fanshawe College drove massive apartment and condo development based on projected enrollment growth that will never materialize. Developers who built thousands of units specifically for student housing are facing bankruptcy as their primary tenant base disappears overnight. But here's the deeper economic devastation. London's service economy was restructured around serving this student population. Restaurants, retail shops, and service businesses that employed local families are closing en masse as their customer base evaporates. When the service economy collapses, it takes housing demand with it. The human impact is staggering. Local families who bought homes near the universities, thinking they were making smart investments in a growing community, are watching their neighborhoods empty out. Properties that were worth $600,000 in 2023 are struggling to sell for $400,000 in early 2025. Here's what makes this particularly cruel. Many London homeowners are baby boomers who plan to downsize and use their home equity for retirement. The crash is destroying retirement plans for thousands of families who had no way to predict that international education policy would devastate their local housing market. The rental market collapse is complete. Purpose-built student housing developments are offering units at 50% below their projected rents just to avoid complete vacancy. When rental income projections are cut in half overnight, property values follow immediately. Local government is facing a fiscal nightmare. Property tax assessments were based on inflated values, and reassessment will cut municipal revenue just when the city needs to invest in economic diversification to survive the crash. But London's policy-driven disaster is still not the most shocking story on our countdown. Number 2, Kingston. This is the city I specifically told you to watch for, and Kingston's housing market crash reveals something that should terrify anyone who thinks historical stability guarantees future performance. This limestone city is experiencing a collapse that defies everything experts thought they knew about Ontario real estate. Here's the fact that will rewrite real estate textbooks. Kingston's housing market was propped up by federal government employees who could work remotely during the pandemic, but Treasury Board directives requiring return to office are forcing massive population shifts that are destroying the local market. Queen's University, long considered the economic anchor of the community, is facing enrollment challenges that will shock you. The university's financial pressures are forcing program cuts and staff reductions that will eliminate hundreds of high-paying jobs from the local economy. When your primary economic driver starts contracting, housing markets follow immediately. But here's what makes Kingston's crash uniquely devastating. The city's historic charm attracted retirees and investors who thought they were buying into a stable, recession-proof market. These buyers paid premium prices for properties they believed would hold value, regardless of economic conditions. They were catastrophically wrong. The military presence at CFB Kingston, traditionally a source of stable housing demand, is undergoing restructuring that will relocate significant numbers of personnel. Military families who bought homes thinking they had long-term postings are being transferred, creating a sudden surge of properties for sale just as demand collapses. Here's the emotional reality that breaks hearts. Kingston attracted young professionals who fell in love with the city's quality of life and paid Toronto prices for the privilege of living there. These professionals are discovering that romantic notions don't support mortgage payments when employment opportunities disappear. The tourism industry that supported many local service jobs is struggling with post-pandemic recovery. But more importantly, it's facing competition from destinations that offer better value. When tourism revenue drops, it eliminates another pillar supporting the local economy and housing market. Local businesses that expanded during the boom years are facing a customer base that's either selling and leaving or dramatically reducing spending due to negative equity concerns. The multiplier effect of housing wealth destruction is visible in every neighborhood. But even Kingston's complex crash pales in comparison to our number 1 city, where multiple catastrophic factors are creating the perfect storm for Ontario's worst housing market collapse. Number 1, Peterborough. Peterborough represents the absolute worst housing market crash coming to Ontario in 2025. And it's happening for reasons that will shock anyone who thinks they understand Canadian real estate. This city is facing a perfect storm of economic, demographic, and policy factors that will create a housing market collapse of historic proportions. Here's the fact that will haunt real estate investors forever. Peterborough's housing market increased by over 95% between 2020 and 2023, making it the most overvalued market in all of Ontario relative to local incomes. The average home now costs 7 times the median household income, which is unsustainable by any economic measure. Trent University, the economic anchor of the community, is facing a financial crisis that will force massive cuts to programs and staff. But here's the devastating part. The university's struggles are compounded by declining enrollment as students choose larger cities with better job prospects after graduation. The manufacturing sector that once provided good-paying jobs is disappearing through automation and plant closures. General Electric's wind turbine facility, once seen as the future of Peterborough's economy, has eliminated hundreds of positions and more cuts are coming. When your industrial base collapses, housing markets follow with mathematical certainty. But here's what makes this crash uniquely brutal. Peterborough became a speculative playground for Toronto investors who thought they could flip properties quickly for massive profits. Now these same investors are panic selling simultaneously, creating a supply glut that will take years to absorb. The demographic reality is crushing. Young professionals graduate from Trent and immediately leave for Toronto, Ottawa, or other major centers where career opportunities exist. The city is aging rapidly, with seniors who need to sell their homes but can't find buyers willing to pay prices that support their retirement plans. Here's the human cost that should break everyone's heart. Families who moved to Peterborough thinking they were escaping Toronto's housing insanity are discovering they've traded one problem for another. They bought homes they could barely afford in a market that was already overvalued, and now they're trapped with negative equity and limited employment options. The rental market collapse is complete. Purpose-built rental developments that broke ground during the boom are coming online to find no tenants at projected rents. Landlords are offering 6 months free rent and still struggling to fill units, which destroys the investment thesis that supported high property values. Local government faces an impossible situation. Property assessments were based on peak values, and reassessment will devastate municipal revenue just when the city needs to invest in economic development to survive. Tax increases are inevitable, which will further discourage homeownership and accelerate population loss. The infrastructure needs are massive, with water and sewer systems requiring hundreds of millions in upgrades. When property values are falling and population is declining, there's no way to fund these essential improvements, creating a downward spiral that will define the next decade. So there you have it, the 9 Ontario cities where housing markets will crash hardest in 2025. From Thunder Bay's resource-dependent vulnerability to Peterborough's perfect storm of overvaluation and economic decline, these communities represent the real human cost of unsustainable housing bubbles. What do you think about these predictions? Have you seen signs of housing market stress in your community? Let us know your thoughts in the comments and tell us which city's situation surprised you most.